Hey investors, welcome to the Asset Revesting Quarterly Report. Today I want to cover a lot of ground, some very interesting things that are unfolding and how our asset revesting strategy works. Now, you may have heard about us through probably our new concept or our new named concept, which is asset revesting. You may have purchased our book or watched a video, heard me talk about it on an interview. More or less, asset revesting is a strategy that I have used for about 20 plus years, constantly refining it. It's all about managing risk, protecting our capital, number one. And if you do that, the profits will follow. This book covers that in great detail, and probably the reason why you could be on this quarterly report right now is because you like the concept, it makes sense, and it protects you, not only your lifestyle, but your capital. Both of those are critical. So let's jump into the charts. It is Monday, July 31st, last trading session of the month. We'll see how the day closes out and how the week closes out. Typically, end of the month, we can get some window dressing, which is when funds and advisors will close out their losing positions, they're the worst positions, and take that money and move it into the leading stocks, which is typically going to be tech, growth, Apple, the big brand names that some market movers in a lot of cases, and it can drive the market higher. And that's because they want their investors, when they get their quarterly or their monthly reports, to see that, okay, I'm doing well, I'm holding all the best stocks, so that's got to be good. So that is what window dressing is, kind of just pulling the wool over the eyes of most investors, and it just tries to, the market just tries to make themselves look better. So that is what we could see, but let's take a look at the overall market stages here. Of course, I cover this all the time, but I want to make sure I always reiterate it and update where we are. We always also have some new investors with us. So long story short, the market has 4 stages. We are currently in this, what I think is a stage 3 topping phase. We're in this complacency mode where the market can work its way up. It can even put in a double top and even poke to nominal new highs before potentially rolling over. We've seen this happen time and time again. And this complacency phase, which if I come down here, you can see it's a complacency phase. Most people think that the pullback and this consolidation is just a pause and that it's going to start a new major bull market and just keep going higher. And in some cases, that's what happens. But overall, I do think the market is going to eventually roll over and go into a big stage 4 decline, and people are going to start to panic. Stage 4 decline here is like the 2008 financial crisis. It's like the tech bubble. Those are the last 2 stage 4 declines. They are devastating to investors who don't have an exit strategy. They are a huge opportunity for those who have an exit strategy and who can profit from falling markets and become wealthier as the markets go down, and then be able to reinvest that capital for potentially some long-term holding positions down after the market has corrected, and then we go into a new bull market that could last another 5 or 10 years. So lots of opportunity coming. But right now we're in this kind of transition phase of the market, and we're just waiting for that top to come into play. And for example, this is the weekly chart of the SP 500. We had the 2022 kind of bear market. The market corrected 25 or so percent. And now it's clawing its way back up. We do obviously have a new kind of investing signal to the upside. So it is trending up, and people are really piling in. We're seeing the ARK ETFs, the leading companies or the growth and tech companies leading the way higher. AI has also been a huge movement in driving the markets higher and getting people back re-energized to invest in something new. Just like before, everybody got sucked into the marijuana stocks. They got chewed up and spit out. And everybody got into the ARK ETFs following that, and it has fallen huge, down like 60, 70, 80%, depending on the ARK ETF, which they're starting to recover. But here we are now in this market. People are piling back into those types of stocks, the ARK ETFs, and everybody's getting very bullish. Advisors are, we are bullish, we are long, and we expect the markets to keep going in this direction until proven otherwise. But advisors, I'm hearing all over the place that everybody is super bullish. This is the time to reinvest, the start of a new major bull market higher. And that is kind of usually the complacency move. That is, everybody's getting really bullish in this phase right in here, piling in thinking it's going to be another 5 to 10 years of growth. But that's what the market does in this complacency stage. It gets everybody on board. And if this market comes up to this recent high, the previous high, especially if it pokes to a nominal new high, like it just pushes up for a week or two or a few weeks, that will get headline news that markets are on a tear. They're in a new bull market, all-time highs. And then the more people will pile in. And as they all pile in and they buy up here at the highs, then the market eventually rolls over with some big reversal bar. And it just is a relentless sell-off where we could see a 30-50% correction in price and wipe out more or less investors that are just trading on kind of the buy and hope emotional strategy going forward. So that is what we need to be aware of. The nice thing about what we're doing, no matter what happens here, we will be just fine because we follow the trends. And then if it does roll over, we'll be getting out if we're in the trade. If it starts to go down and we get a stage 4 decline, we will benefit and profit from falling prices during a downtrend as on its way down to a stage 4 decline, because it will take a lot of selling to kick us over into a full-on bear market. We could have other plays in there where we trade bonds or we trade the US dollar index. So there will be different plays that we can do during this other time here as the market works itself out. So that's kind of that game plan. Now, if we take a look at, so this is the weekly chart above here. Let me just pull it over. If we overlay it with our CGS strategy that we trade, you can see there are many more trades, especially during a choppy time. We're in and out more frequently because we want to protect our capital. When a new trend starts up, we can get in, we might hit a target, and then our break even or trailing stop might get triggered. That can happen over and over again because we are protecting our money. We don't want to just plop it in the market without an exit strategy, and eventually you get caught. This is the thing. People who hold on say, if you just held on to the play, you'd be up really well. Well, the reality is when we do hit a stage 4 decline, and they're rare, but they do wipe you out. And I would much rather be nimble and protect our capital than sit there thinking that if we're just in the market, we'd be doing better, which isn't the case, which I'll show you in a minute. But eventually there will be a wipeout event that destroys your account and all that stuff. And it's just a matter of time. You can go on for 5 or 10 years without having one. But then when one hits, it comes out of left field and it's devastating. And it happens to almost everyone who doesn't have a strategy. And in most cases, it'll happen 2 or 3 or 4 times in your lifetime. The tech bubble, the 2008, those are 2. I think there's another one just around the corner, and I'm sure there'll be another one in 5 or 10 years from now again. And if you happen to be, at the wrong age, or wrong timing, when one of these happens, it can devastate you for 5, 10, 15 years before your account starts growing again, as we've seen with the tech bubble. That was 16 years for the NASDAQ to come back, 12 years for the SP 500. It's just not worth risking it. It's better to be a little more active, protect our capital, than get hit and wipe out, your whole life of working and saving and being diligent and have it wiped out for no reason, or being overly aggressive in growth stocks and getting sucked into just wanting to own good things, which isn't always the case. Good things fall 50 to 70% still. So it's all about following price. Let's take a look at the different indexes here. We got into the NASDAQ. We hit our targets. We are out of the NASDAQ. It has continued to move higher, which is perfectly fine. We pulled out the safe amount of money, statistically showing this market eventually is going to have some type of big correction and crash or pause. It will give us red bars. Once that does happen, we'll be able to reload, get into a position, and then ride it for another move up. It's not about trying to be thinking you should catch all of this move. As the saying goes, bulls make money, bears make money, pigs get slaughtered. And that is what this type of thing is really important to understand. There's the FOMO, the fear of missing out, of not being in something that keeps going higher. that is more painful than taking a loss. That's just the way the brain works, but you need to wrap your head around. It's not about trying to catch this entire trade, thinking and being greedy of saying we need to catch all this, we're missing out. Because the key here is we don't want to try to make as much money as possible, because that comes with high risk. We want to make consistent money and above average returns, which is what we are doing. And a really good example of that. So the NASDAQ has rallied up, and let's go take a look at the NASDAQ here. If we look at the NASDAQ and zoom back, the NASDAQ is not making new highs. All this big recovery rally is just that. It's a recovery rally for those who took a beating and are recovering, getting back what they had lost. In reality, it's the same with the NASDAQ. If we were to take a look at our portfolio holdings, well, we are trading actually higher than this now because the SP 500 continues to climb and we own it. We are actually hitting all-time highs while the stock market is still below those highs. Whether it's the NASDAQ, which has had a huge rally this year, it's still down. The SP 500 or a 60-40 portfolio, even a 30-70. I know a lot of you have a 30-70, meaning you're mostly in bonds. You have some stocks just because of your demographic. That is what most holders have. You're the markets in those positions are way down versus us hitting all-time highs. So even though we're not catching all of this rally, the key is our account keeps making higher highs and is outperforming the market. And in short-term spurts like this, where the stock market has a massive rally and we just catch a portion of it, yes, the market technically in that small window is outperforming us. But in the big picture, when you step back and see how we're actually doing, we are wealthier than we ever have been because our account keeps hitting new highs, where the stock market and any other trader and advisor is mostly just earning back money that they had lost over the past year or two. So that is really, really important concept to grasp, because I know a lot of people are struggling saying, this is a huge rally. We're not fully committed in it. We've sold a lot of our positions. We've got a lot of cash, but just keep in mind, we are hitting new highs in growth. Don't get caught up with these big moves thinking you need to catch every piece of them and you need to be in the markets. That is what gets you into trouble because the markets have a great way of taking money from you if you try to make as much as you possibly can from it, thinking you need to catch every move. Let's go take a look at the SP 500. SP 500 was a little more choppy. We had an entry signal. We took a very small loss on it because we had the financial banking crisis. It wiped out the SP 500, causing a trigger. Eventually, the market shook off that news. We got a new trigger, and we've been riding that up. We've hit our first target. We're heading up to our next target, which is a 12.5% gain on this position. We're in striking distance of literally, potentially this week, we could even squeeze up there. We're not that far away. When we look at it percentage-wise, we're about 1.2% away. So any news or pop and rally will allow us to hit that next target, liquidate some more of our positions, and lock in more gains, which reduces our risk. So if the market, when eventually it does pull back, we're not caught giving back much of that gain. So all those things are kind of coming together. If we look at the overall markets in general, if we take a look at some defensive sectors here, utilities are known as a defensive sector. They're kind of bouncing bottom. They've started to move up a little bit. They're pulling back to the 50 and 20 days, so they might find some support and start to rally higher here. You can see on the 30-minute chart, we dipped into lime green territory. That is an oversold condition. That usually is a technical level where buyers step in and they'll say, okay, it's oversold, I'm going to buy it. And we're actually seeing it pop today. We even had an oversold down over here. And it kind of pierced through this pink line, which is the 20-day moving average. Typically, you can pierce it or you find support near that level, and we're starting to see that. If we look at consumer staples, known as another defensive play, it's actually rallying fairly nicely. It's holding up and moving higher. That means there is some big money slowly rotating into these defensive sectors, thinking that the market is starting to get a little overdone and it might have more of a pullback. Another defensive sector is healthcare. It's had a very strong pop. It's pulled back with a tight bull flag. We'll see how that unfolds. But overall, we are seeing the defensive sectors holding up fairly well. When we take a look, let's take a look over at the dollar and precious metals real quick here. The dollar has bounced up into a resistance area. The 50-day moving average, this low through all of this noise, this previous low. So it's a pretty significant resistance area. That typically means it's going to trade sideways or lower from here. If we flip that to gold, gold is pulled down to support. It's starting to bounce. It has a bit of a bull flag pattern here. So it could start to move up as a defensive play and move higher. And that is what we're seeing. You can see here on our 30-minute chart, gold dipped into an oversold level. It's popped. It's had a little bull flag. It's starting to have the second half of that bull flag move, probably to come up somewhere to this big gap fill that is on the chart for that gold move. Overall, gold and silver and miners, let's take a look at them real quick. Here are the gold miners. They have a similar pattern. They could be primed and ready to move higher. To move up as a defensive play. We have seen this before when the stock market starts to get a little bit choppy and potentially close to selling off or moving lower. Gold and miners can move up as a defensive play. And so we have that pattern, that bullish pattern playing out here, and it looks like it could go higher. So that is, I'm not saying this is the start of a new rally for precious metals and miners. They are far off their highs, especially if we go way back to 2012. They are down huge. This could just be a rally back up to these recent highs, maybe up into the 40 range, which is a significant high many times over here, twice, plus a lot of noise through there. It would be a complacency rally, a defensive play, but it could very easily, after it rallies up, it could sell off and go into a huge sell-off with the stock market if we go into a stage 4 decline. And eventually, when it puts in a bottom and starts to build a base and a launch pad, it could be the start of something much bigger that lasts several years. And this is what we've been waiting for a long time, and I don't believe we're there yet. We still have more pain, more fluctuations for that. And that'll be the same for gold, silver, and the silver miners. They're all the same trade. I'm looking at crude oil, up 1.1% today, continuing to push up. It's getting up into this upper range here. Definitely seeing some strength in the commodity space, but overall, again, we're not involved in the crude oil space. The only thing that's interesting there is, OIH, the holders, is up the most, kind of really performing very well. It's doing one of those running corrections where it's channeling to the upside. It rallies, it pulls back, it rallies, it pulls back. It's kind of correcting as it goes. These are very tough chart patterns to read. They can be kind of bearish, telling us there's volatility, and at any point it can have a big crack and then sell off and go down. It can also mean that it's correcting as it goes, and if the run up before the correction, at the end of that correction, you'll have the second half of that run. It can be a very explosive move. So again, it's a real crapshoot of which way it's going to go. The trend is up. It is channeling up. And at this point, if you're in the energy space, you've got to be long. There's no reason to be picking a top or shorting it by any means. The trend is up. Trends are more likely to continue than they are to reverse direction. Let's take a look at energy, crude oil. You could say, dirty energy is up. We could take a look at PBW, which is clean energy. It's also been doing fairly well. It's rallied up. It's consolidating. Obviously, it's been suffering a lot. Clean energy was a huge mover after the COVID. We saw a massive movement there. It has definitely fizzled out. And recently, it's got a little bit of a bid here. It looks like it's got a little bit of a bull flag. We'll see if it can get some traction and start to move higher. But again, long-term trend for this is down. And if we take a look at TAN, which was the other one that had a huge move back during COVID, if we go back in time, you can see these massive moves at a major topping pattern and breakdown. It's been flatlining and trading sideways. In fact, the last 2 weeks, it's been moving down, going the opposite of crude. So we definitely have some money rotating around in the energy space, from clean energy to dirty, to dirty energy right now, crude oil at the moment. Another interesting point here is bots, which we added several weeks ago. More or less, I think we added it somewhere right over here near the high. A lot of people wanted to get an AI ETF in here. And what's interesting is it has pretty much gone sideways and flat ever since then. And in fact, it was top of the list when we added it in here. And now it's down in the lower third quadrant. Almost everything else is outperforming the AI space. So this is a potential warning that maybe the bubble here has come to an end. We've got the top, we've got a potential another top. You could argue this, if this starts to break down and goes below this level, it could unwind fairly quickly. This space, when you look at this ETF, you look at the volume, very, very little volume, started to gain some traction, and the volume keeps ramping up, and we got lots of volume. So this is telling us that the masses piled in, and now everybody else is still piling in. And this is where the majority of the volume has traded. The majority of investors have got in here. Typically, this could be a big top. Typically, the masses, the investors, get in near the top, and then it'll flush down and sell out, and they bail out at the bottom. Buy high, sell low. That is the mentality, or not the mentality, but the scenario that plays out with average investors who don't understand trends, cycles, chart patterns, position management, all that stuff. They get really chewed up and sucked into these type of moves. Other than that I think that wraps it up for the report, and we'll talk to you soon. Take care. Bye-bye.